flying cars used to be, well, pure sci-fi.
Right.
Like something you'd only see in a comic book or a movie set in, the distant future.
Yeah, exactly. The Jetsons kind of stuff.
Totally. But today,
Yeah.
they are actually a heavily traded ticker symbol on the stock exchange. We're looking at Joby Aviation, ticker symbol JOBY.
A fascinating one to watch right now.
It really is. As of April 21, 2026, the stock is trading at $9.14, which is down about 0.87% from its last close. And looking at the sheer volatility of this chart, we have to ask you a very pointed question.
A big one.
Right. Are we looking at a falling trend with flashing sell signals? Or is this a strong buy that the market is severely undervaluing right before a massive breakout?
That really is the ultimate question for this entire sector right now.
Yeah, and our mission for this deep dive is to tear apart the financials, the technical charts, the insider moves, and, the Wall Street consensus. We need to figure out if this stock is a revolutionary opportunity or if it's just a classic retail value trap as it nears its targeted 2026 commercial launch.
It's a lot to unpack. And hey, just a firm reminder before we tear into all this data, what we are doing today is an intellectual debate. We're just analyzing market mechanics.
Exactly.
This is absolutely not financial advice.
Right. Definitely not financial advice. Oh, and real quick, if you're enjoying the deep dive, please like the video and subscribe to our YouTube channel. And it is compulsory that you leave your feedback in the comments. We want to know what you think.
We always read them.
We do. Okay, so before we even look at the charts, you have to understand the cold, hard reality of their ledger. Because as much as we all want to commute in an electric air taxi, you cannot build the future of aviation without an Earth-sized wallet.
Yeah, aviation is notoriously brutal on capital.
Insanely brutal. Joby is currently in a pre-revenue, or I guess very early revenue phase, and the capital expenditures are just staggering.
To say the least, right.
If you look at their income statement for fiscal year 2025, they reported a net loss of $929.8 million.
Almost $1 billion.
Yeah, nearly $1 billion in losses against a mere $53.4 million in revenue.
Right, and when you look at where that capital is flowing, it's heavily weighted toward research development and building physical infrastructure.
It's not cheap.
Not at all. I mean, this isn't a software startup where you code an app in a garage and scale it on a cloud server with zero marginal cost. Aviation requires massive upfront capital.
Because you're dealing with actual hardware.
Exactly. You are designing physical aircraft from scratch, building specialized manufacturing facilities, employing top-tier aerospace engineers, and funding years of rigorous testing.
But then you look at the balance sheet, and they are sitting on a very strong asset position. We're talking $1.79 billion in total assets compared to just $385.4 million in total liabilities.
Which looks great on paper.
It does. But looking at their cash flow, they burned $509.9 million from operations in 2025 alone. However, thanks to early 2026 capital raises, they have a pro forma cash liquidity of approximately $2.6 billion.
That's a massive war chest.
Okay, let's unpack this. That $2.6 billion sounds like an impenetrable fortress of cash, like a giant fuel tank on a rocket. But if they are burning $500 million a year from operations before they have even truly launched their core commercial service, I mean, it feels like paying to keep a massive international airport running every single day for a flight that hasn't even been scheduled yet.
That's a really good way to put it.
Right. So with a burn rate that aggressive, does that massive asset sheet actually guarantee survival, or is it just a very expensive mirage?
Well, it guarantees survival, but for a very specific, limited window. In this specific industry, a high burn rate isn't necessarily a red flag of mismanagement.
Okay.
It is simply the cost of admission. That $2.6 billion liquidity figure is their lifeline. In the pre-revenue phase, a company's entire existence is dictated by its cash runway.
Because without it, they're dead in the water.
Exactly. That $2.6 billion ensures they can keep the lights on, keep manufacturing test models, and just keep pushing through the immense regulatory red tape without facing bankruptcy in the next 12 months.
So it buys them time.
Right. It doesn't guarantee they will ever be profitable, but it guarantees they stay in the game long enough to find out.
And the market is clearly anxious about that exact timeline. You see it in the 52-week range, swinging from a high of $20.95 back in August of 2025, all the way down to a low of $5.61 in April of 2025.
That is some serious volatility.
Yeah, it's wild. So if the fundamental financials show a company just playing a massive waiting game, we need to look at how the market is pricing that wait right now.
Yeah, and when fundamentals are stagnant and purely forward-looking like this, traders rely heavily on the charts to see the actual flow of capital.
Okay, so what do the charts say?
Right now, the short-term trend is looking neutral to bullish, but the long-term trend remains heavily pressured by overhead supply.
Yeah, looking at the downside support, the stock is historically finding buyers stepping in at $8.26 and $8.09.
Which is a solid floor.
Right. On the upside, immediate resistance is sitting at $9.23, with a massive block of overhead resistance looming up at $12.67.
That $12.67 level is going to be tough to break.
Definitely. And the momentum indicators are incredibly conflicted. The RSI, the 14-day RSI, is hovering right in the middle between 52.6 and 53.0.
Basically telling us the stock is just catching its breath.
Yeah, exactly. But the MACD, which tracks that trend momentum, is flashing completely bipolar signals. Daily views show a buy signal at 0.16, but we've also got a very recent sell cross-sitting at negative 0.39.
Yeah, the moving averages really tell the true story of this internal conflict. The stock is finding some bullish support right now by testing the 50-day simple moving average at $8.82.
Okay.
However, it is fighting a brutal uphill battle to reclaim its long-term averages. The 200-day simple moving average is looming significantly higher, stretching between $9.03 and $13.02, depending on the time frame parameters you're looking at.
Here's where it gets really interesting. You have this short-term strength wrestling with a massive cloud of long-term weakness.
Yep,
But I have to play devil's advocate here.
go for it.
For a stock whose entire commercial existence relies on a future Federal Aviation Administration approval, literally just a government stamp due technical indicators like RSI and moving averages even matter.
It's a fair question.
I mean, isn't this just traders reading tea leaves while they wait for a bureaucrat to make an announcement?
Well, you're not wrong. An unexpected FAA announcement tomorrow would instantly shatter every single support and resistance line on that chart.
Right, it would just blow past them.
Exactly. A definite yes sends it vertically, and a definite no crashes it straight through the floor, regardless of what the RSI indicates today.
So why even look at the chart?
Because during these long, quiet waiting periods between major announcements, the technicals perfectly visualize the daily psychological tug-of-war between retail hope and institutional memory.
Oh, wow. Okay, so you're saying the 50-day average is essentially the pulse of the retail trader?
Pretty much, yeah.
It's holding at $8.82 because there's a baseline level of excitement about the upcoming 2026 launch, so people are just blindly buying the dips. But that 200-day moving average overhead, that represents the institutional bag holders. The funds that bought in at $15 or $20 got burned by the endless delays in the cash burn and are now just waiting to dump their shares and break even the second the stock rallies.
That is exactly what the chart is showing us. The short-term enthusiasm is constantly slamming into a heavy, heavy ceiling of long-term doubt.
Man. So if the charts show this massive tug-of-war, I really want to know what the people actually building the planes are doing.
The insider activity.
Right. Are the insiders holding the line or are they cashing out? Because recently there has been significant net selling by company insiders.
Yeah, there has been some movement there.
Chief Product Officer Eric Allison and CEO Joe Ben Bevert executed sales in mid-April 2026. Combined, they've sold over $2.2 million worth of shares over the last 90 days.
Which sounds scary.
It does. As an investor, if I see the CEO and the Chief Product Officer dumping millions right before the most crucial commercial launch phase in the company's history, my instinct is that the captain is abandoning ship.
Sure, but context completely shifts that narrative here.
How so?
The SEC filings show these sales were executed largely to cover tax obligations from RSU settlements.
Restricted stock units.
Exactly. When executives are compensated with RSUs, those shares eventually vest and become their actual property. And the IRS taxes that vesting event as regular, ordinary income.
Oh.
So an executive might receive millions of dollars in stock, instantly triggering a massive tax bill, but they haven't received any actual cash to pay the IRS.
So they have to sell to pay the tax.
Right. It is standard corporate practice to automatically sell a portion of those newly vested shares just to cover the taxes. It's administrative housekeeping. It's not a panic sell.
Okay, so the CEO selling shares to pay the taxman isn't the red flag. The actual glaring red flag here is the short sellers.
Oh, absolutely.
Because the short interest is dangerously high at 13.3% of the float. That means roughly 86.7 million shares are currently being shorted.
That's a massive bet against the company.
Wall Street is actively borrowing tens of millions of shares just to bet that Joby's price is going to collapse. And the days to cover ratio is sitting at 3.82.
Yeah, that days to cover ratio is the crucial metric to watch.
Explain that for us.
It calculates how long it would take for all those short sellers to buy back their shares based on the stock's average daily trading volume. A ratio of 3.82 means it would take nearly 4 full days of average trading for the shorts to fully exit their positions.
Wow. 4 days.
Yeah. Anything above a 3 indicates a deeply entrenched, confident, bearish sentiment among smart money. They are looking at the cash burn, looking at the regulatory hurdles, and heavily, heavily betting against the company's timeline.
Which perfectly explains why Wall Street is completely fractured on this stock. Officially, the analyst consensus is a hold. But if you look under the hood, it's incredibly polarized.
Extremely polarized.
You have 29% of analysts rating it a strong buy, with price targets soaring up to $18 to $22.
The optimists.
Right. Then you have this massive middle ground, 43% to 57% saying hold or reduce, with average targets between $11.80 and $13.81. And the 14% to 28% are issuing flat-out sell ratings.
See, the analysts issuing the 22 tire price targets are looking at the technology, the AI integration, and the corporate partnerships.
The shiny stuff.
Exactly. The analysts issuing the sell ratings aren't looking at the tech at all. They are purely doing the math on the short interest and calculating exactly how quickly Joby will run out of cash.
So this split consensus really sets up the ultimate debate for you, the listener.
Mm-hmm.
Is Joby a misunderstood, undervalued innovator on the brink of revolutionizing transit? Or is it a value trap designed to crush retail investors?
That's the million-dollar question.
Or multi-billion-dollar question,
Right.
right? If we look at the bull case, the absolute best-case recovery scenario, it relies on capitalizing on that $2.6 billion runway.
Right.
They have heavyweight institutional backing from Toyota and Delta Airlines. They are integrating advanced AI for complex airspace management. And most importantly, they have a clear path to an initial commercial launch in Dubai slated for late 2026.
Yeah, that Dubai launch is critical.
Why Dubai specifically?
Because the UAE offers a much more agile regulatory environment compared to the United States. If Joby can successfully execute commercial flights there, it proves their operational model works in the real world.
It proves it's not just sci-fi anymore.
Exactly. It proves the unit economics. If they hit that Dubai timeline and production scales without catastrophic delays, bullish financial models suggest this stock has the momentum to return to that 21-plus range by 2027.
Wow. But then there's the bear case, which is entirely rooted in the punishing math of that $500 million operational burn rate.
The math never lies.
It doesn't. Even with $2.6 billion in the bank, a semi-annual cash burn of over $340 million means they are on a very tight ticking clock. Projections show they will likely need upwards of $1.5 billion in additional capital by 2027 just to keep scaling production. And to get that capital, they have to issue more shares, which leads to massive dilution.
Yeah, dilution is the silent killer here.
And on top of the financial risk, the market for electric vertical takeoff and landing eVTOL is entirely untested. If the FAA type certification slips or gets delayed by even a single year, the cash runway evaporates.
Gone.
Bearish models predict a major regulatory delay could send the stock plummeting back down to $5.60 by the end of 2026.
And that shared dilution risk is exactly why retail traders often get trapped in these specific types of revolutionary stocks. They fall in love with the what-currency while completely ignoring the mechanics of the how.
So you're saying retail investors are so blinded by the sci-fi dream of a flying car that they're just completely ignoring the financial math happening behind the curtain.
Pretty much.
They see the $21 price target, but they ignore the gravity of a float that is nearing 1 billion shares.
Precisely. Let's look at the math of that 1 billion share float for a second.
Yeah, let's do it.
If a company has 100 million shares and the stock is at $9, the market values the company at $900 million.
Okay, simple enough.
But Joby's float is nearing 1 billion shares. At $9 a share, the market is already valuing Joby at roughly $9 billion. If you are a retail trader waiting for the stock to hit that bullish $21 target, you are asking the broader market to value a pre-revenue company at over $21 billion.
And so what does this all mean? It's basically the pizza analogy, but on a massive scale.
Exactly.
To keep the lights on and fund the R&D, Joby has to keep cutting more and more slices of the pizza to sell to new investors. So even if the company succeeds, launches in Dubai, and gets FAA approval, the stock price itself might struggle to reach those previous highs simply because there are hundreds of millions of new shares diluting the value of each individual slice.
You nailed it.
That is the essence of a value trap. Technology succeeds, the company survives, but the stock underperforms because of the weight of its own cash burn.
Which is why you have to separate the viability of the physical product from the mechanics of the actual stock. They are two different things.
Okay, so synthesizing all of this, the cash burn, the divided Wall Street consensus, the massive short interest, what should you be watching out for next?
The short-term catalysts.
Right. In the short term, over the next few weeks, expect the stock to consolidate right around that $9 level. Because in the options market, $9 is currently the max pain point.
Yeah, and for those tracking options, the max pain point is the strike price where the highest number of open options contracts, both calls and puts, will expire, entirely worthless.
A lot of money on the line there.
Always. Market makers and institutional writers often hedge their positions in a way that naturally pins the stock price near that max pain level heading into a major catalyst.
And that major catalyst is literally right around the corner. The highly anticipated next earnings call is scheduled for May 13, 2026.
That's going to be a big one.
Huge. That will be the immediate driver of volatility. They will have to answer for the burn rate and provide concrete updates on the Dubai timeline.
Right. And looking past May into the long-term outlook for 2026 through 2030, absolutely everything relies on two binary events.
Okay. What are they?
First, the successful execution of those initial commercial flights in Dubai in late 2026.
Got it.
Second, and ultimately the most vital, securing the final FAA type certification. Without that FAA stamp, they cannot scale in the United States, and the entire valuation model just collapses.
Wow. You know, to truly grasp the context of Joby's massive cash burn, you eventually have to look at how their competitors are navigating the exact same airspace.
You really do. You have to compare them to their primary rival, Archer Aviation.
Right.
Joby has chosen a highly vertically integrated approach, meaning they are trying to build and design almost everything in-house.
Which gives them total control over the technology.
It does, but it requires a staggering, continuous cash burn. Archer Aviation, on the other hand, is heavily outsourcing components to established aerospace suppliers.
Oh, interesting.
Yeah. Archer's approach theoretically lowers their upfront cash burn, but it means they will have to share much of their future profit margins with those suppliers. Watching which strategy survives the regulatory gauntlet will dictate the future of this entire sector.
Yeah, we will absolutely be putting Archer Aviation under the microscope in a future deep dive to compare those strategies head to head.
It'll be a fun one.
Definitely. But for today, we've laid out the entire puzzle for Joby. You see the incredible $2.6 billion cash reserve, but you also understand the terrifying $500 million annual burn rate that is eating into it.
Yep.
You see the bullish retail traders aggressively defending the 50-day moving average, but you also see the entrenched 13.3% short interest actively betting against them.
It is a company attempting to engineer something historically difficult, requiring unprecedented capital, all while racing against a ticking regulatory clock that they fundamentally do not control.
It's a high-wire act for sure.
Yep.
Well, we want to thank you for joining us on this deep dive. But we aren't going to tie this up with a neat little bow today.
Never.
We're going to leave you with a provocative question to mull over on your own. Looking at everything we've just uncovered, looking at everything we've just uncovered, if Joby is burning $500 million a year just waiting for a government stamp of approval, are you investing in a revolutionary aviation company, or are you just subsidizing the most expensive regulatory waiting room in history?